Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So let's get more on those retail sales. Shor, Senior Equity Analyst at Columbia Threadneedle Investments, joins us now. On the headline, it looked quite good, particularly when it comes to the jump in car purchases. What were some of your takeaways from the report this morning?
Yes, thank you again for having me. As you said, it was a solid sales report across the board, even when adjusting for the later start to the holiday and the unfavorable weather in the first part of the month. And we're really seeing the consumer show up and spend across category into the holiday season as we expected.
That's kind of where I want to go. Mari, what are you hearing from the retailers just about the holiday shopping here?
Yes, it's interesting because I think it was a very strong Black Friday. There was a lot of concern, as we spoke about, regarding the shorter holiday selling season. But I think that has, in fact, really motivated consumers to get out and spend. And if anything, I think the retailers have been positively surprised by the performance in the business post Black Friday. And we've even seen in some cases them pulling back slightly on promotions. So I think overall the tone from the retailers is optimistic, and hopefully we continue to see the strength as we move through this final period.
TBD on tariffs, though. So I'm wondering two things. One, what you've heard from retailers about how they prep for tariffs, and two, if we get a sense if people are buying ahead of, particularly maybe when it comes to cars, for example, or like a dishwasher or something along those lines.
Those are great questions. Most of the companies that I speak to have been moving production out of China for almost 10 years now. So actually, a lot of the companies are suggesting that the impact from tariffs will be pretty limited. I would say the one real exception is consumer electronics. Listening to Best Buy talk, they still say 50% of their goods are sourced from China. So outside of consumer electronics, I think the companies feel pretty good about their ability to manage through this situation. But of course, they are also saying any tariffs that they do feel, they will try to pass along some of that cost to the consumer. In terms of bringing in goods earlier or consumers buying goods earlier to get ahead of that, I don't really get the sense that companies are going to be doing that aggressively because there are still a lot of questions about what the tariff outcome is. So I think those impacts are more minimal at this point.
How are consumers paying for this stuff that they're buying with all these goods and services here?
Question.
It seems like they've drawn down, I hear reports that they've drawn down their savings. Are they putting this stuff on credit, and is that a concern?
I think at the lower end, we're absolutely seeing that consumer, which has, been stretched for a couple years now, rely more on credit, as you said. But at the high end, that consumer is in very good shape with the wealth effect between the housing market, the stock market. So I think that consumer is, behaving a little differently versus at the low end where we are seeing them rely more on credit.
What are your top picks right now?
So my top picks are kind of a combination of some of the quality share gainers that we've talked about on the show. So some of the large retailers that offer that combination of value and convenience that's really resonating with the consumer right now. So I would put, the Walmart, Amazon, Costco, TJX in that bucket. But then on the other hand, I think there are some really interesting turnaround names, specifically in the apparel space, where you don't need a lot of top line growth to generate pretty meaningful margin and free cash flow improvement. So some of the names I would highlight on that list would be some of the specialty retailers like Gap and Victoria's Secret, and even some global brands like PVH and Contour brands.
All right, Mari, thank you so much for joining us. Mari Shor, she's a senior equity analyst at Columbia Threadneedle Investments. I'd love to chat with her on these days when we get retail sales to get a sense of how the consumer's doing out there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get back to the markets here. Bank of America had an interesting note out that said, look, guys, cash levels are going to the point where you might actually want to start selling equities rather than buying them. Apparently, fund managers have been reducing cash holdings to a record low, and they're now below 4%. So is that a cue for you? Well, joining us now for more is James Abate, Managing Director and Chief Investment Officer over at Center Asset Management. James, is there a sell signal within the equity market?
Well, I think if you look at just like at the tail end of the dot-com bubble, clearly price momentum and valuations now are beginning to outpace the improvement in fundamentals. I mean, just looking at the top 10 stocks, probably the biggest disconnect is in Microsoft and Broadcom. I mean, clearly what we see that's similar to the dot-com environment, namely like a company like Cisco in 1999, you have returns on assets or returns on invested capital trending lower, highlighting that margins and/or asset efficiency is rolling over despite sales growth. Heavy capex in the case of Microsoft, acquisitions in the case of Broadcom. The other Mag 7 are simply overvalued, but there's no evidence yet of fundamental deterioration to the same degree that we see in those two names. But there's no margin of safety for investors. I mean, the group as a whole is trading at 13 times sales.
Yeah, exactly. The valuation is just extraordinary. The only differential I call out from the late 90s is they actually have earnings and free cash flow, which is a little different from some of the stuff I was selling back in the day. James, where do we go here in 2025 if, in fact, we have some valuation concerns in this market?
Well, I think, the way we look at stocks from a valuation perspective, we emphasize future growth reliance. That is essentially, what is the metric companies need to reach to be able to justify their existing valuations. And for us, on the overall S&P 500, the measure now hasn't been this optimistic on future economic profit creation going forward since 2009 and close to the all-time high back in 2002. Now, those times we were both at the bottom of a very deep recession and set for a very sharp cyclical recovery. And the S&P 500 PE multiple back then was at 11 and 13 times respectively, not 24 times like they are now. So we have to basically essentially see a rapid acceleration in economic activity just simply to justify, the multiples that we're seeing today. And we have a hard time reconciling those figures with what we're seeing from a bottoms-up perspective.
So what's your best well, not guess, because you're actually putting money to work, but what's your best setup then into next year?
Well, I think when you look at next year, you have to think about two events happening, right? We have, heading into the year, investors appear to be universally bullish. In fact, we saw yesterday the Conference Board's consumer confidence survey showing individual investors being the most bullish they've been in 40 years. And consensus seems to be that nominal economic growth is going to be exceptionally strong. Profits going to accelerate, and additional fiscal and monetary stimulus might help further, and a broadening out of market performance. I mean, at the same time, this is happening while manufacturing PMIs remain stuck in recessionary levels. Services actually appear to be rolling over. And even today, U.S. industrial production and capacity utilization fell, not showing any type of inflection. So our view is to stay defensive. We think long treasuries might be the ultimate contrarian trade for 2025, and classic defensive growth stocks in healthcare and staples, although very out of favor right now. But many of you could pick up that PEs of 9 and 10 is the place to be heading into next year.
How about fixed income here? Do I sit my 2-year treasury at 4.24%, or do I take some credit risk?
I would stay away from credit risk. Clearly, if you think that the economy is not one where the cyclical or industrial side is going to catch up to at least the buoyancy in the services, I think you want to, with credit spreads being at extremely tight levels, consistent with really a zero equity risk premium, you want to be in safe assets, and that would be treasuries instead of credit.
All right, James, thanks so much for joining us. Always appreciate getting a couple minutes of your time. James Abate, he is Managing Director and Chief Investment Officer at Center Asset Management. He is in New York City.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Something is evolving quite interestingly in the oil and gas market for next year. Yeah, we still care about shale, and we care about Guyana, and we care about the Saudis. But offshore drilling, particularly in the Gulf of Mexico, is becoming more and more of a topic in conversations among my oil and gas folks. And let's get to one of them now. Brian Gilvary is chairman of INEOS Energy. INEOS Energy is a private company, and it recently bought CNOOC, which is a Chinese oil company, Gulf of Mexico assets. Brian was also the former CFO of BP, so he knows like a thing or two about how to put together assets and finance them and do stuff with them. Brian, it's good to see you. It's been a long time.
Hey, good to see you as well, Alix. It has been a while.
So tell me what led to this acquisition, why'd you like it, and why now?
Look, we created INEOS Energy just literally out of COVID in 2021. We brought together a collection of oil and gas assets we had. We did some major portfolio transition. We took a big U.S. onshore position last year from Chesapeake, so that sort of built up a decent-sized 2,600 well position there, an LNG export option, and then the next obvious spot to go to was the offshore Gulf of Mexico, which is probably one of the highest margin barrels available globally, and we've been looking around now for the best part of 3 years for the right deal, and this was the right group. It's a great team that we get with this. It's the ex-Nexen team that CNOOC had acquired. So we'll get Heather, the CEO, and Ariel, the CFO, as part of that transaction will come across. So yeah, we're pretty happy about it.
So talk to us about that part of the world, energy in that part of the world, the Gulf of Mexico specifically. What are the dynamics of getting a barrel of oil out of the Gulf of Mexico? Seems like a tough business.
No, look, it's one of the most prolific basins in the world. I've got personal experience of it from sort of, 20, 30 years ago, of the early pioneering groups of effectively back then, Chevron, Shell, BP, that kind of went into that zone. I think there's still a lot of legs. And I think the most important thing about that particular region is we've got a very stable fiscal regime. Its successive governments have continued to support that region in particular and the onshore. If I think back to the last conversation, Alix, I think it was when the Biden administration was coming in and there was concern about what would happen with onshore fracking in the United States. That's got to record highs. I mean, the US now accounts for something like 20% of all of the world's oil production, including condensates and natural gas liquids. So look, it just continues to be a great place to do.
Exactly, which is so interesting. So you have now Gulf of Mexico, so that's deep water. You have LNG export assets, and then you also have gas. How are all of them going to wind up working together?
Well, look, so we'll be exporting LNG probably 2026 onwards. We have the new contract in place. We have effectively, over the last 18 months, repositioned that onshore position that we picked up from Chesapeake, the Eagleford position, which was mostly oil. Actually, it's like sort of 85% oil with oil liquids. It's got a decent amount of gas in there. These two assets, they're non-operated. We've got great operators in both. Shell in one asset, Hess in the other, which is obviously becomes Chevron. And we'll learn a lot about that particular region. We then also have a growth oil business in Denmark and a gas business in the UK. So we'll start to bring that virtual web together. And as you'd expect, Alix, on top of that, what we're building around that web of assets is a trading business, both LNG, gas and oil trading. So that will then start to ensure that we can pick up the incremental value that comes from moving those products around the world.
What's the competitive environment for you in kind of your businesses there down in the Gulf, down in the South Texas area? How do you compete against some of the bigger companies there? What's the strategy?
I mean, in this case, we're not operated, right? So we get carried by the two main operators, which, as I say, are sort of two of the sort of top operators in the Gulf of Mexico, and have got the long history of operating there. So we'll get carried as part of that. We'd like to get to an operator position. I think we have big ambitions. And when we started to create this company out of INEOS already massive footprint in the United States as a petrochemical company. And as we started to build up the energy business in 2021, the ambition of our owners, Jim Ratcliffe and his two partners, has no bounds. And therefore, I could see us at some point in the future building this out into something much bigger, maybe in the same sort of size as our chemical company.
Hey, Brian, before we let you go, talk about the trading part of it. Because clearly BP's trading arm is the giant, right, of all the oil majors. Exxon has wanted to kind of build up its own trading unit. Like, everyone kind of wants a piece of that pie. How are you guys going to do it?
Look, it's really hard. You have to have the DNA in your system to really be successful. We've hired a couple of people that we know well. The first thing we did over the last 6 months, actually last 18 months, we built out a risk structure. Because, of course, if you're going to trade commodities, you need to absolutely ensure that you have the right risk framework around that. So we built out the risk capability. We've started now getting ramped up for our LNG trading operation, which should start in the next 2 years. And then oil trading is short steps, but it's with an experienced team that we already know. And of course, because we have this massive industrial footprint called INEOS, it's the third largest chemical company in the world, that gives us access to flows globally. So that'll be short steps, but the key is to make sure that we've got that capability that allows us to add those extra cents to the margin on a barrel.
All right, Brian, really looking forward to getting a more update from you. Keep in touch. Let us know when the next events happen. Good to see you, Brian Gilvary. He is joining us from INEOS. He's the chairman of INEOS Energy, previously the CFO of BP, which is where he and I started talking years and years and years ago. So you see kind of the evolution of someone's career is really quite interesting.
I want to get on one of those offshore rigs.
Me too.
Let's see if we can.
Did you know that if you do that, though, you need helicopter training?
Helicopter training?
Yeah, so
just to be a passenger?
Yeah, so the helicopter training is you're in a pool and they put you in a helicopter and they dunk you and you have to swim out by yourself, and you don't get certified unless you're able to swim out by yourself. Oh. And one of my biggest fears is doing that. So
that's an issue. Okay. I'd still like to try it, but all right, we'll see how it goes. Because I always thought that would be, I can't imagine being out in the middle of the ocean on one of those things.
Yeah. Well, especially,
and then doing that dangerous hard work too.
Yeah. Well, that's why the automation piece of oil and gas is so critical, because if you can do that, reducing the amount of people that you're putting in any sort of harm's way offshore, like, that's huge. And that's an industry, and mining also, where like that automation hand is not just a cost saver, it's like a lifesaver. So it's interesting to see how they manage on with that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, in the markets, S&P is down by 0.4%. The Nasdaq off by 0.3%. What to do headed into the Fed? Dana Dioria is co-chief investment officer at Evestnet, joining us now. Okay, you have on one hand Bank of America saying that cash levels are hitting a level where you may actually want to sell equities. T. Rowe Price saying you could hit 6% on the 10-year next year. What do you do?
Well, that certainly flies in the face of what we've been hearing for a long time, which is, more consistent with a risk-on market, consumer spending obviously doing well, not a bad, nothing like a bleak picture for employment. But I think what's happening and what you're starting to hear and reference is things are getting ahead of themselves, as they sometimes do, right? And as good as it seems right now, and not a lot of reason to expect headwinds, the market is just pricing in good times at a faster rate maybe than what we think that we can actually sustain. And so value matters, price matters, and and you're seeing a little bit of that now, right? So maybe a little bit of a backpedaling there. But, I think the market has been and continues to be pricing in a very rosy scenario. And, it's not that we're without reasons to think that could tamp down. And one of them, of course, being that notwithstanding, the rate cut this month, when are we going to get continued rate cuts? Are we going to have a pause as soon as January?
So from a positioning standpoint, Dana, is 25, the beginning of 25, look different for you guys than kind of maybe where you ended 2024?
I think 25, it's interesting because we sit at the nexus of a lot of different, economic input from macro analysts and asset managers, et cetera. And it's interesting just to look across what you're starting to see come in around 2025 outlooks. Some of them are, we're going to see some consolidation. A lot of it is we have a good reason to think that the good times keep rolling, at least in the beginning. I think consensus, sort of, at least the way I see it coalescing, is around we don't have a reason to expect some sort of, big market correction early into 2025. Mm-hmm. But a lot has to pan out still, right? We have to understand how the new administration's policies are really going to be implemented. Is it going to be all the way to where maybe some of the rhetoric is, or is it going to be tamped down a lot when it's things like trade and tariffs? What are we going to see in terms of bills that extend tax cuts, et cetera? So there's just a lot that has to be that is still unknown. Mm-hmm. But I don't think as you roll into 2025 you're going to get those answers that quickly.
So if you had to choose, what do you do with small caps versus mega cap tech? And I know that's not necessarily a fair comparison, but I'm basically talking about growth that's working, and that's been tech, versus small caps that are still waiting for that sustained bid.
It's such a good question. I am a believer in valuation. I am a believer that no matter how good the outlook for, the numerator, right, the cash flows, you really have to pay attention to the denominator and how much they're being discounted by. And, we're just in another phase where mega cap and growth are running wild. And, my instinct is to say, you got to at least diversify into other parts of the market. You got to make sure your portfolios, it has a robust keeping of, and small caps stand to win, right, with a lot of the policies that potentially could be brought to bear. The tariffs, they're not hurt as much by that. Granted, if we have a little bit higher for longer, that's not as good for small caps. They're definitely more interest rate dependent. But, they stand to benefit if it's a risk-on environment. And I lean toward, at the very least, have them in the portfolio. And frankly, if you can stomach short-term volatility, maybe even a little bit of an overweight, because over the long haul, they should outperform, especially small value stocks.
So, Dana, when you see a security, and I guess I'll call it a security here, like Bitcoin, effectively double almost since the election, what does that tell you about, I don't know, just the market, I guess?
So Bitcoin's a really interesting asset, right? Because, on the one hand, there's a whole element of it being potentially a currency, and, it's unfolding literally before our eyes whether, it can gain traction in that respect, and what the next administration will do to make that happen. I think for most investors, though, it's really more obviously, is it a return enhancer for the portfolio? And you can gain access to Bitcoin from that perspective with a variety of ETFs now. We're seeing it right here on our own platform. This is not just, kind of investors on their own. You're actually seeing advisory assets entering this space, institutional assets enter this space. That tells me that, there's just more solidity underlying that. You have papers out there from big asset managers around utility functions with Bitcoin, and the fact that, for most people, because there's such an asymmetric payoff, it has sort of this lotto aspect to it. For a lot of people, some small slug of Bitcoin actually could make sense because the upside is much bigger than the downside. So I think you're seeing an institutional interest there that maybe wasn't there before. And you can get access if you want to participate. We're cautious about, how much you should put to something like that. Very volatile, obviously. But if you want access, I think these ETFs that are backed up by big asset managers take the risk out of, the operational risk out of the position. You can do it.
It was interesting. Cameron Kreis writes Macro Man, a column every morning. And today, in his column, he said he really wants a reporter to ask Jay Powell tomorrow about the surge in fart coin and what that might say about financial markets and risk appetite. Bitcoin aside, it's a great point. When you have the mega cap growth, tech stocks, and then you have Fartcoin doing really well. All right, Dana, thanks a lot. Dana Dioria, she's joining us there, Co-Chief Investment Officer over at Evestnet.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.